Against the euro, we're down some 20 odd percent. That's how bad the depreciation has been.
It could be possibly a concern on maybe slightly mildly stretched valuations on the broader market front.
The earnings growth are not going to be that exciting. I believe it's going to be around 8 odd percent.
Good evening. Thank you very much, Dinshaw, for joining us for another session of Market Pe Charcha. We've been, in fact, talking about most of the things which has happened, but all the way from Jan, when we started talking about the way the demand had collapsed, and there is a requirement for consumption boost, and then followed by the events which has taken place, and in fact the recent GST thing. So where do you think are we heading now? What's your take on this entire GST rationalization event, and how it's gonna impact, because we've been very, very vocal about this. In fact, we launched our midcap also in March, April, and obviously which has done fantastically well for us. But where are we now, heading to? I mean, amidst this tariff related hiccups and some kind of undecisiveness in the market, while you look at all the other indicators are sort of pointing towards a positive outlook. But what's your take, in terms of the direction of the market from here?
Thank you, everybody, for joining in today. I'm not in office. I'm traveling outside, so I'm taking the call from outside. So pardon any disruptions if it happens. So that way. But let me start off with the direction of the market. So basically, our belief is and our feel is that seems the market has digested the worst possible news all along the way. It started off with the degrowth in earnings way back in September, when we had hit a peak of 25%, 25 times forward earnings as such. And obviously wasn't the drop in earnings wasn't well accepted by the FIs, and they started selling. And since then, they've been selling quite a bit, right? So that was the first of the bad news which came in. Then came in, obviously, the tariff wars. All along, we thought that Trump will be good for India, but turned out that the other way around, right? We probably the only one of two where the tariff is at 50%. The other one being Brazil, as such. Even China is not having that 50% tariff as such today. It's 35%. But anyway, we have 25% regular tariff plus 25% penal tariff, which came around later. So that was another set of bad news. The earnings degrowth continued, happened in September, but the flat line earnings growth was literally going on till around June of this year. Even this quarter, the earnings growth are not gonna be that exciting. I believe it's gonna be around 8 odd percent. But that's mainly because the banks are going to see some pressure on their net interest margins. And as a result, the banks will either have a flat earnings growth or probably a negative 2% on an aggregate basis. In fact, banks is a big chunk in the index per se. So if you remove banks, probably the growth will be in the early teens, 11, 12% kind of growth as such, which is not that bad a news as what the earlier quarters was bringing by. Yeah. So, and by the way, let me be clear that it's a very optical growth, because September of last year was a negative growth quarter. And that's why this growth will look good in the light of that, right? So it's not sequentially, it's not going to be that great a growth. Yeah. So that's on the earnings bit. So that was the second set of bad news which hit us as such. And obviously the FI selling, which continued right up to till this particular day itself. I mean, the last couple of days they've been biased, but not that exciting bias. But the fact is that that negative news has continued in, right? But now let's look at the positives, right? So that's why I said that the worst of the negative news seems to have been discounted. And our belief is that from here on, you can only see positive news items coming, right? So RBI's actions, we've talked about to the bone about their actions and how productive they've been under the new chairman of RBI, Mr. Sanjay Malhotra. And one has seen a lot of liquidity getting infused in the system. One has seen interest rates getting cut off quite aggressively by him. On the government's part, they've done their bit also. They increased the tax slabs from 7 lakhs exemption to 12 lakhs exemption. And plus the fact that they cut GST into two slabs. The third being a very thin slab of 40%, but otherwise the 28 came down to 18 and 12 came down to 5, which was a very exciting move according to me. So instead of four slabs, now we got two, and one obviously the thin slab. No more surcharges on top of these slabs. So it's a pure and simple 5 and 18 and plus 40 for the sin, right? So that itself has cut down the consumer prices and made it very exciting. If you remember last couple of calls, we've been saying that on the part of RBI, they've done their job. They've infused a lot of liquidity in the system and the money is cheap, right? The interest rates have been cut. The government also has done their part. Now the whole economy needs a kind of a spark. I think the spark was basically the GST cut, which according to me was basically a no-brainer on the part of the government, because I don't think they're going to lose too much, even on the collection front. The last data point that I saw was probably around 10-15 basis points of GDP that they lose out on. Otherwise, it's going to be a very exciting move on their part. Anyway, the states have the leeway of taxing sin products like tobacco and alcohol to overcome whatever deficit they have seen in their respective collections. And plus, oil and gas is always a cash cow for them as such, so that way. So I don't see much of that, right? Now, the demand growth because of the GST cut. Now, let's understand one thing, that this announcement of GST cut, though it was given out officially on 22nd, rather on 2nd of September, but it was pre-announced by the Prime Minister on 15th of August. So as a result, and by the way, 2nd of September, they announced it, but the cuts were effective from 22nd of September. Yeah.
Yeah.
That's because the Shraddh period of 20 days was there, and
Yeah.
that's why they didn't want to time it with that. Yeah. So let's understand one thing, that from 15th of August onwards till 22nd September, everything got postponed. All the demand was postponed. Only the essential sales were happening. So this pent-up demand which came by on 22nd was so aggressive that none of the distributors, none of the retailers were prepared for it. In fact, the last we were talking to the various distribution channels and the logistics companies, and they were telling us that their systems are blocked. In fact, the truck operators who are specialized trucks that are used for two-wheelers and four-wheeler transports, as in the mobikes and your car transport, they are totally out of capacity. They said there's no way they can meet this kind of a demand. The retailers are shouting that we have done the sale, but we don't have the product to deliver. So that's what's happening on that front, and hopefully that will get sorted. It's a problem of plenty, which is always welcome, right? So my feel is that if you look at the December quarter, which is starting now, I mean, it started on October 1st, I believe that that quarter should be the turnaround quarter in terms of growth. You should see somewhere like mid-teen kind of growth starting to creep in, right? So that's the first good news, okay? The second good news is obviously will be when the FIs come back. Now look at India from FI perspective. India has underperformed almost 30% on a one-year basis. MSCI India, I'm talking about, vis-a-vis MSCI emerging markets,
Emerging market.
right? Underperformed by 30%. Now, last 3 decades that I've been around, more than 3 decades that I've been around, I've never seen this kind of a massive underperformance, right? In fact, last I read Bank of America report where they said that this is a 35-year low that they're seeing in terms of underperformance for India. Yeah. So that underperformance itself makes India look very attractive in the eyes of their FIs. I mean, the ones who moved out, they like the underperforming stories, because later when growth comes in, these are the stories which really pick up with a vengeance, right? And as I said, growth is supposed to pick up from December quarter onwards. Yeah? So that's one. Secondly, the currency. Bad news on that front. We are probably the only currency in the world which is depreciating against the dollar this year. While most of the currencies have appreciated, we are the only ones who have depreciated. And depreciation has been so bad that against the dollar, though we've depreciated some 5.5% year to date, I'm talking about calendar year to date, against the euro, we're down some 20% odd. That's how bad the depreciation has been, because obviously euro has just shot up against the dollar, and as a result, India INR looking very attractive. But I believe that's basically the excesses of last year which are now coming to bear on us, right? The excesses of last year were that we were trying to manage the currency, keeping the rupee stable to the dollar. And obviously, when the new RBI governor came, I think he came with a mandate of increasing supply and demand in this country. And so that's why he came up with this plan that I will rather buy rupees, sell rupees and buy dollars. That's what his plan was. That's the first way he started off. And as a result, the rupee has weakened and will continue to weaken. But I think now it's stabilized at around 88, 89. That's what the level is, and it's remaining quite stable there. So that's a fairly acceptable level even in the eyes of the FIIs, right? So they're seeing the INR depreciated when the world currencies are appreciating against the dollar. It's a matter of time before this trade reverses. And obviously, they're very keen on this trade reversing because they can go back with more dollars when that happens, and they come in with more rupees when the other way is working out. So that's what the good news on the currency front is also. In terms of valuations, again, from a peak of 25 to a low of 19, which is today, I think the valuations have done a total turnaround, right? At 19 times, we are probably on an average 15 years average as compared to the MSCI India. Yeah. That again is very exciting news for those guys. Yeah. So that's another positive that's looking in. So reasonable valuations, attractively underperformed, the attractive underperformance that India has gone through. And obviously the fact that demand is coming back. So these are the potent mix that should work towards the FI coming back or trickling back into the country. Obviously, the real trigger will be when the earnings growth kicks in. That's when they'll come back lock, stock, and barrel, right? Now, coming to the tariffs angle, we are not privy to any news, okay? But whatever you see, whatever social media you read, it feels as if at least the penal tariff of 25% that has been applied on India because of imports of Russian oil may just go away probably in a month or two, right? I don't have any news on this, but you get that palpable feeling when you see these tweets from Trump saying that India is not the only one. It was also Europe, which was importing big time from Russia and stuff like that. So, in fact, in the last few tweets, it's becoming more leaning towards India because they are also desperate to get India back on track. They don't want to lose India to a China and Russia, right? So that's what they want to do. I think India's plays its card perfectly well in this kind of a face-off with the US. Had they bowed back like the EU did, it didn't win any friends in US by doing so as such. Neither did it win any friends in the EU itself. So I think India has done a phenomenal job of managing this kind of a tit for tat with the US as such. Already India's gone back and said, I mean, that's what we read in the papers, that we are ready to import your corn, but it'll be used for ethanol manufacturing and for cow feed, right? So that's our way of compromising. Obviously, we are not agreeing on the dairy imports, but US has gone back and said, look, I don't want to export milk to you guys, but I want to export high-end cheese. Now, that obviously is a no-brainer because nobody buys high-end cheese in India. If it does, it's a couple of households, uh, probably a couple of thousand households which buy high-end cheese. So these kind of compromises makes you believe that even on the trade front, the 25% tariff, which was one of the highest among other countries, I think will come back to a very reasonable 10-15%.
Yeah.
If that happens, we're in the game. Already 25% tariff that was initially there has been absorbed even by the industries that were penalized for it, which is textiles and carpet manufacturing and all these guys, right? So they did manage to pass on quite a bit, but it was only the penal tariff of 25 which was a problem. Yeah? So if that happens, I think we are fairly in the game after that. And as I said, that will be a very big positive news coming through. So already you're seeing domestic demand coming in. If tariffs get reversed, you're looking at again exports picking up. So we're in a very sweet spot. Obviously, this quarter will be the quarter where all these things will pan out, the December quarter. And if it does, I don't have any doubts that the markets will rally, the FIs will come back, so will the investors. So that. By the way, Devi, the worst case scenario that I see is probably a time correction. Even if these
Okay.
things don't pan out, probably it'd be a
Yeah, on the
time
back.
correction.
Yeah, because
So that way.
because
Yeah.
it could be possibly a concern on maybe slightly mildly stretched valuations on the broader market front, though, but But what's your take on the small cap and mid cap, Dinshu? I mean, while I see that on a if these things have to fructify, and if earning growth has to kick in, then I see them quoting at a much better or sane price to growth kind of valuations, right? For the kind of growth this pocket. So which one, mid cap or small cap or large cap? Where do you place them in the overall scheme of things?
Purely on valuations, if you break it up, obviously the large caps are the cheapest, followed by the mid caps, and obviously the small caps are the most expensive, right? But on a
Mm.
peg basis, is the other way around. Yeah, I mean, they're obviously the large caps still remain cheap, but the mid and small caps are not that expensive. Also on a peg basis, when you look at that, right? Price earnings
Mm.
to growth. Yeah, yeah,
Number, yeah.
yeah. So that way. But let's come back to the mid cap and the small cap, because large cap 100. I don't think there's much leeway by fund managers, and as a result, they just track the index in the large cap space. There's not much alpha to be made there. You just went go along with the index. Some may change composition here and there and make some couple of points of alpha, and that's about it. But the real winner, according to me, will be mid and small caps going forward, right? Mid caps, since we have the index and I can vouch for it, mid caps 150 normally just is not a stagnant index, right? It's a very dynamic index because that mid cap 150 keeps changing every 6 months. Some of the mid caps fall off into small caps, some of the large mid caps become large caps, and some of the small caps become mid caps. That's how the replacement happens, right? Um, so basically, if you see the composition of this mix every time it happens, you'll see that quite a few small caps get into the large cap, mid cap space. Only a
Yeah,
handful of mid caps become large caps, and a handful of large caps become mid caps. But the small cap moving in is much higher. And as a result, the mid caps dropping off into small caps also are much higher, right? So that's how the mix changes every time. Yeah. When that happens, when the small caps get into the mid cap segment and some of the mid caps fall off. So please understand the low momentum mid caps are falling off. And the small caps are getting in with a move that is fairly high, right? So as a result, the mid cap index is always the best return index. But that's because it's not the same 150 stocks, it's different 150 stocks. Yeah.
yeah,
And that's why when we came up with our mid cap index, but just let me refresh memories of people on the call. We actually got the approval for the mid cap index in August of last year, but we didn't launch it because we felt the valuation was very frothy and we didn't have any ideas. Finally, we launched it in Feb when we had enough ideas, but the money flow was fairly constrained because everybody was scared about mid caps. Yeah. The strategy of launching the mid cap at that point in time, we were very clear that it's going to be a mid and small cap index. There won't be any large caps in that because what we were trying to achieve by doing this mix was not only high beta, high alpha, but also the fact that the small caps, the ones which are expected to get into the mid cap space, you build a nursery of those small caps in your mid cap fund. So when that move happens, you capture both sides of the move from them becoming a small cap to a mid cap and avoid the mid caps which drop off the chain, right? So the low momentum ones will drop off and obviously the high momentum small caps will get it, right? So that was the whole logic. And that's why touchwood, we've done fairly well in that particular index and sorry, in that fund. So that's on the mid cap. Now, why we are launching a small cap? By the way, we are launching a small cap. Then we'll
yeah.
brief later.
But before you go to that, Dinshaw, one, and I will ask it in a reverse way. So one should pay, or where does the return come? Return comes by looking at the trailing P, or return comes by looking at the forward P. I mean, what is the, because as you rightly mentioned that there is too much of sorry, move around in the mid cap space, right? So rightfully mid cap will have always the best of the
Returns.
momentum small caps, right, coming in there. But then unfortunately the small cap universe would be filled with, so that's why if you look at the big picture small cap 250 number, right, on a long term basis also, it is like in and around the mid cap performance, right? It doesn't show. So it actually says that the bigger game here is stock picking. In fact, the data which I was looking at of mutual fund performance for long period of time, had shown a dispersion of 12% CAGR versus 18% CAGR. So there was a 6% difference between the two different fund houses, right? So it is clearly a fund manager's game there. So what is the point? I mean, one should invest looking at forward earnings expectation, or looking at trailing P, and then restrict investments into this space, and then in a way lose out on that expected earning coming up.
So basically, Devi, I think it's compromise between growth and value, right? And as we rightly put it, we try to get growth at a value. Yeah.
Yeah,
And only when you have that mindset will you be able to identify stocks which are rightly priced, though they may look very expensive in terms of
yeah,
standalone
yeah, yeah.
P's. But when
Yes.
you put that growth equation in place, they start looking very reasonable per se. Yeah. The same question was asked to us when we bought a Zomato, probably, or Eternal now. The name has changed, but Zomato, when we bought at 55, 60 odd bucks, that time there was no PE. It was a loss making company, and everybody said that this is a stupid trade, right? And you've seen where the stock is today, right? Same was the question that was asked to us uh, when we bought an Ola, right? Loss making, where is the hope and stuff like that. And
Yeah,
anyway, Ola, I believe, is yet to prove it. And I think
yeah,
September quarter will be the quarter when they will prove that they are on the right track. And I
yeah,
don't see any difference here because I haven't seen the management going on any defensives. They're still very aggressive in terms
yeah,
of their projections and stuff like that. Yeah.
yeah,
So September should prove that. So I believe that this is what one has to look at. One has to look at the value in terms of the growth per se. If the growth is high, the obviously the valuations, if they're loss making, are nowhere. There's infinity, right? But even if they're high, and suppose the PE is say 60, but the stock is going to grow at say 50% for the next 3 years, that 60 to come down to 15 will take 2 years, right? Even if the stock doesn't move. Yeah.
yeah,
But obviously that 60 will keep remaining at 60 because if you're talking about a 50% growth, that's going to be, so that's a huge multiplier for you. Yeah. And even if it comes off, there's a re-rating which happens at a later date. So I
yeah,
think that is what one has to look at. And as I said, that though you may feel that the mid caps are very heavily valued, but even if you remove the 30 odd mid caps in the 150 odd universe, which is at P's of 100 plus, the valuation becomes very reasonable. Same is the
yeah,
case with small caps. If you look at the 250, they look very
yeah,
frothy, right? But you look at the small caps that we are holding, they're beyond those 250. And that
yeah.
is what excites us in that. So that way, I think that's the game that you need to play here. So,
So it's basically, what in a way you are saying is that growth comes with a price, right? Growth, you
right.
have to pay a price. You can't
But
be
honor
looking at.
the, yeah,
Yeah, it's not other way around, that it can't be cheap, because if you look at, whatever the expected earning growth numbers which we see, large cap universe, single digit or below, higher single digit number, and the mid cap is higher teens, and the small cap is, upwards of, on a slightly better number, right? So of course, that comes, and then that is the hedge which we know as a manager we have to take, right? I mean, where do you allocate, where the growth is coming, you allocate there. Dinsho, within the small cap space, or uh, how do you see that being different today? People. So this entire capitalization game, right? Large cap, and mid cap and small caps, right? These are all names, based on market capitalization given, but ultimately these are all companies, right? And they had constraints maybe a couple of decades back, and today, so how do you see them, in this era of, the entrepreneurial cult which is going on, and the new world, of entrepreneurs and startups. So how do you see this entire pack compared to, maybe 2 decade or 3 decade when you started investing, in your olden days? How do you see and compare between these things? What is the difference? Why do even somebody should be scared of a smaller cap company in today, when people are investing in private equity owned, startups, right? Why should they be scared of listed small cap universe?
No, actually, Devi, when probably when I started investing, India's premium in the MSCI was hardly any, right?
Okay.
Because our index used to compose of cement companies and steel companies and auto plays and what else? Yeah, conglomerates like Indian Rayon and Grasim and all these guys. So that
Yeah.
way, our premium was hardly any. Today, even after this 30% underperformance that
Yeah.
India's seen in the last 1 year, our premium that we
Has come down.
command and P's to the MSCI EM is around 60%.
Yeah.
And
Yeah.
that's mainly because of the new age companies that we have come in with, right? We have got exciting offerings in the IT space and the platform space and stuff like that. That's what makes India very exciting in terms of these things. And as I say very jokingly to anyone who asks me this, cares to ask me that if I was going to raise money in the US for India, and if the investor, prospective investors out there ask me, what am I going to buy? And if I tell them I'm going to buy a cement company, I'm going to buy a utility company, I'm going to buy a steel company, they'll tell me, look, we got all this and out here also. I mean, why do we need to go to India for that? Because the growth rates are more or less similar, right? And if I tell them, no, 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 I'm going to buy a Eternal and a Swiggy, which are the answer to Mituan in China, or I'm going to buy a fintech company like a Paytm, or I'm going to buy a platform company which is akin to, which is cart rate basically, and akin to your multi-billion companies out there, that will
Yeah.
excite them more, right? So it's a no-brainer that whatever the new money comes in, that will come in obviously in these exciting sectors which are giving you phenomenal growth. In fact, in these e-commerce companies, quick commerce companies, or whatever you want to call them,
Yeah.
the registered user base of Indian internet users is 950 million users, which is 95 crore people. But
Yeah.
the regular user base is roughly around 30-35 crore people, which
Yeah.
is like the whole population of US on the internet, right? And these guys are at what, 2 crores and 2.5 crore odd consumers on a regular basis. So either got a
Yeah.
long way to go for these kind of things to work out. And I think that is where the real alpha lies for new investors and obviously the old ones as such also. So platform companies will continue to rule the roost. And
Yeah.
obviously you seeing newer and newer age companies coming out with their IPOs and stuff like that, which is the exciting part out here. And that's why we are very clear that when we buy a IPO, it is not because we're trying to do some profit harvesting and looking at a pop as such. We are very selective in our IPO process and only very selective. And one has seen that in our fund, right? There are
Yeah.
hardly 3 or 4 IPOs from the time of the inception that we've participated in as such. And I think we'll continue to be that way.
So then, there was a time, in the early 2000s, or maybe before that also, there were time when there was constraint. There was a muscle power which was with the larger companies, right? Smaller companies to struggle for cash and other things. Even some of the larger companies had logistical advantage and so on, right? But today, where do you see those things playing out in today's, in this decade? I mean, do you see that they having the same kind of constraints, be in terms of money or in terms of management compliances and even logistical or distribution related or issues? Do you think that they continue to face these issues?
So basically, Debbie, I think the one thing that India has done, and which is probably the best thing that it has done, is these new age online payment systems that we've developed, right? Uh, had there not been a UPI, half the e-commerce companies would have been having a viable model as such, right? So that is what has helped us. I think those days of having these physical model going or cash changing hands and bank transactions happening is done and dusted, right? It's all online. In fact, the data point that I share with everybody is that in India, 97% of the online transactions are instantaneous. As in, if I'm to pay you, I do the transaction on mobile and your account gets credited instantly,
Yeah.
right? That's 97%. We take it for granted. We think that, okay, this is how transactions are done. You go to the US, that same figure comes down to 6%. There are cases when you do a transaction and after 3 days the money comes and hits your account, right? Where it gets lost, nobody knows. I mean, I'm sure the banking system is earning out of it, but we take it for granted and that doesn't happen there. And these are the kind of things that has helped India in a very big way as such. So I think that's a perfect way to go. So those old days are over, and now it's the new age which is coming by, and I think that is what you want to play with as such. So that way.
Dear participants, please type in your questions, whatever questions you may have for me, Dinshaw, or for Helios. We will be, happy to take those, in just a while. While the questions, come in the Q&A box. Dinshaw, so this entire GST rationalization, the tax money which has been given, right? So what is your estimation, or what is your, you know, idea about uh, the addition which will maybe happen to the overall GDP, I mean, of the country? I mean, where do you see this? Because this will have its own velocity of transmission, right? So you, while you touched about it, but in detail, when do you see these things reflecting in real numbers? Maybe how many quarters, or this festive demand, do you think that this can continue this time, like it got collapsed last year, right? When during the festive demand, after the festival, it was done. So where do you think this, these things playing out? How do you think these things play out?
So basically, Devi, the fact is that I mean, there's only empirical evidence that we can share with people as such, and the
Yeah,
empirical evidence is fairly exciting. As I said, that we're running out on logistics. We are seeing stocking out happening, stockouts happening as such, and it's obvious because such kind of drops have not happened before. In fact, even in the super luxury space, the cars have dropped quite sharply, and I don't know whether you read that news article from Mercedes saying that they've
yeah,
been selling every Mercedes during Navratri time. They sold one Mercedes every 6 minutes, right?
yeah,
That's huge for them because they,
yeah,
they probably would have sold that many in a month, which they sold
yeah,
in 10 days
absolutely.
per se. So and we call ourselves I mean, not we, but the outsiders call us a dead economy. I mean, no economy can do these kind of things. A dead economy can do this kind of things that we've done, right? So it's
Yeah,
obvious that things are picking up. Now, for it to sustain, I think the government on its part has done quite a few things, right?
yeah,
Obviously, that comfort level which has come through. And I believe it will be at the expense of probably infra spends on the part of the government. They may just cut back on the infra spends. So I don't see the GDP getting impacted because of the cuts on the negative side, right? For the private sector will start moving beyond that 65, 66%, which is the comfort level.
hmm,
Normally, one has seen that once they hit the 65, 66% utilization levels, the private capex starts kicking in. Private sector
yeah,
capex starts kicking in, right?
yeah,
Once that happens, and by the way, nothing can parallel the private sector capex because it's a very productive capex. Unlike a government spend, which is
mhm,
mainly on infra and provides a job only for that moment when the infra is getting executed. In the case of private sector, it's a productive assets which comes by. Governments also are productive because in the long run they provide logistics and support and stuff like that.
yeah,
But in the case of a private sector, the moment they set up a plant, there are ancillaries which come by and they add to that job growth, right? And that is what is the exciting part. So when you see this private sector capex coming in, you'll see new jobs getting offered. The consumer who's already looking at some job satisfaction, some job stability, he'll start seeing new
hmm,
opportunities coming by, and that will give him more comfort to spend. He spends more, demand moves up more, utilization moves up more capex spends happen. This is how the upward spiral is looking like, right? So on the longer term, if this sustains, I have no doubt that our domestic economy will be the one which will be like running away. In fact, let me give an example of China. China till around 2000. So basically, India and China's GDP, and I've shared this before also, in 89 were more or less similar, right? 230 to 40 odd billion dollars, both of us were at. And China opened up for outsourcing in 87 and probably started picking up from 89 onwards. And by in 2000, their economy was $1 trillion. They quadrupled their
yeah,
economy while India just doubled it to half a trillion, right? So that gap of 1 is to 2 open up because of outsourcing. But from 2000 onwards, when they hit that per capita of 23, 24, $2,600 as such, which India has today, right?
Yeah.
The the pickup in domestic consumption happened by 19 end, and I'm stopping there because after that COVID hit and China went through a spiral. But by 19 end, they were at almost a 20 trillion economy. We were at 2.5 trillion, right? So you can see that gap, which was earlier 1 is to 2, becoming 1 is to 7, purely on domestic consumption. That's what domestic consumption can do to you. Because we're talking about 140 odd crore population going in for that kind of consumption. Now, this is what is exciting for us. So once this consumption kicks in, no economy in the world can ignore India. And I think the US is seeing through it. And that's why they are now making sure that we don't lean towards Russia or China and remain with the US or the Western world as they would want to put it. So that's where the excitement comes from, Devi.
Then, so coming to some of the sector views, what are the two sectors which you see very, which are like, which will maybe be the ones to look forward to in the coming next year or so?
So basically, Devi, one sector which we are very keen on, and by the way, uh, we did change a bit in that sector was BFSI. All along, we felt that BFSI is the sector which will be the biggest beneficiary of consumption, domestic consumption. By the way, we were never too enamored by these outside-facing uh, stocks, right? And that's why we always avoided China plus one play, or we avoided the PLI plays and stuff like that, because we knew that it's a short-lived fancy and may not hold good for a long period, right? Domestic consumption was what we were keen on, and that's why we stuck out to those, right? So that was one. So obviously, BFSI being a big play on domestic consumption, we knew that this is going to be a winner, and that's how we stuck on to that. However, one saw that once the aggressive interest rate cut started on the part of the RBI, we did change the mix. 40% demand and 40% our weight, but the mix shifted from banks to NBFCs, right? We started lapping up on NBFCs. And why NBFCs? Because banks will obviously, in the immediate short term, a quarter or two, they'll see a compression on their net interest margins. They're not as nimble to change their cycle as fast as the drop in interest rate happens. 50%, 50 bip cut in one go was obviously a very bad move. Very good move on the part of the RBI, but a very bad hit for the banks at that point in time for that particular quarter and the next one, I suppose. But NBFCs are very nimble. Both their legs of the balance sheet are on short cycle basis. So they can adjust it very well. And plus, when money becomes cheaper, consumption moves up. So you've seen how Bajaj Finance has done, right? Biggest of consumer NBFCs. So that way. So we change the mix there. The second set that we like is obviously new age companies is very well known. But the second set of that's obviously one big chunk for us. But the real I think differentiator for us is that we like things like hotels. We like things like hospitality. More or less both are in the same space, right? Because they are provide one provides quality rooms for tourism, the other one provides quality rooms for healthcare, right? The deficit in the quality rooms is what is a question mark. Yeah. In fact, today only I read in the ET, in the city where I am, that the room rates in Goa for December have shot up to 1 lakh rupees a night. Right.
Oh my
So,
God.
and the cheapest of hotels is 40,000 rupees or so. So
Yeah.
it's like obvious that there's a lot of paucity and there's a lot of money lying with the Indian consumer, and
That
he
even the
saved a
flight
lot because
prices
of
have gone
GST.
up. Even the flight prices for the
Yeah,
December has gone up.
that has gone up through the roof, so that way. So
Yeah.
basically, now that we're launching a small cap, and I don't know how many of you guys know about it, but I think we are launching it on 6th of November, and I think it shuts on 20th of November, right?
Yes.
The whole
Yes.
idea is not that basically, if left to us, we would have wanted to launch it earlier because I think the time is just ripe. But
Yes.
unfortunately, there were a lot of festivals happening, so there was not a clear date for us to launch
Yes.
it. the whole idea is that now we're seeing a lot of small cap ideas which look very exciting to us. Uh, and for me, I would have ideally fitted into my mid cap portfolio because I have a 65% weight in mid caps and 35 in small caps in my mid cap fund. But that 35% is proving to be a constraint for me. And as a result, we felt that there's enough space for a new fund to be launched in the small cap space. And that's how we're launching it. So that way.
And then we will anyways be, doing road shows in most of the
Yes.
cities starting 28. Our teams will reach out to you. We would expect, we request you to join us for the sessions when we will be talking about small cap and why small cap and what makes us so bullish on small cap space in detail. So we will take your questions maybe during the road shows. Till then, stay safe and wishing all of you and your families a very, very happy Diwali. Thank you very much, Dinshaw, and thank you very much, participants, for taking out time to join us this evening.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.